What does pass-through mean in business? Essentially, a pass-through entity is one that doesn't pay any taxes itself. Rather, it passes its income and therefore tax liability to its owners. The profits or losses get reported on the owner's level and are taxed under the individual income tax code. Pass-through entities include sole proprietorships, partnerships, LLCs, and S-corps. It's Miss Tax on Track, back with another S-corp video for you. If you missed any of the other videos, please check out our IGTV and get caught up. Today, we're actually going to be going over what pass-through is and how it works. So let's start with the Tax Cuts and Jobs Act. It created a valuable deduction for small businesses, self-employed individuals, and real estate investors. It's known as the Qualified Business Income Deduction, or the pass-through tax deduction. The simple version is that qualified individuals get as much as 20% deduction from their income from pass-through entities like LLCs and partnerships. The pass-through tax deduction is designed to encourage Americans to actually start small businesses and encourage and engage in entrepreneurial ventures. In a nutshell, it treats income that comes from certain non-employer sources in a favorable manner. So why not start a business? How does pass-through work within an S-corp? Basically, the income reported from an S-corp is passed directly to the owners of the business and taxed as personal income, making it exempt from corporate income taxes, allowing owners to pay the individual tax rate rather than both the corporate income tax rate and dividend tax rate. When it's time to file your taxes, each owner's share of the business earnings gets reported on a Schedule K-1 like it would for a W-2 if you were an employer, which then you use to file your taxes with, just like a W-2. Sole proprietorships, partnerships, LLCs, and S-corps are automatically considered pass-through entities. The pros of the pass-through entities are the tax rate reduction. By treating business income as personal income, pass-throughs avoid the double taxation of a C-corp. Secondly, they're easy to set up. Some require very few fees and registration, making them a seamless start. Lastly, the special deduction that pass-through entities can potentially deduct up to 20% of their qualified business income under the Tax Cuts and Jobs Act make them favorable. Now let's get to the cons. Some cons of pass-through entities are the stock limitations. Since S-corps are limited to 100 shareholders and one type of stock, it makes it extremely difficult to find investors sometimes. Secondly, it's difficult to deduct charitable contributions. Unlike a C-corp, pass-through entities cannot deduct charitable contributions as an expense. And lastly, shareholders are taxed on income they haven't even received. Owners of pass-through entities must pay tax on business income even if the money remains in the business bank account. Pass-through entities are one of the many business structures options that you have, but be sure to explore all of the pros and the cons to better understand what they have to offer for your business. Overall, pass-through entities enjoy more beneficial tax treatment, but they are not always the right choice for every single business. If you found this information valuable, please like, comment, and share. For further assistance, do click the link in our bio or find Tax on Track on the Jumpin' Jack Tax app. And if you're interested in becoming a JJT licensee, reach out.